Palantir stock is up over 500% this past year. The company is the AI darling of the nonsense news, and after their recent earnings release, the hype pressure has been maintained. The company jumped 7% after earnings. That's adding $28 billion of market cap to a company that's $400 billion in size. The company has cut staff to try and be more efficient and attributes this positive momentum to the astonishing impact of AI leverage under the direction of the colorful CEO Alex Karp, who has described the stock as anomalously bullish. Jim Cramer has said Palantir stock is dramatically undervalued and that the doomerism surrounding it is because the short investors just don't see the big picture. One analyst described Palantir as the Messi of AI. That's the sort of comment that should give us pause to look a little deeper beyond the headlines. So is Palantir the big AI winner? And more importantly for us as investors, can the company grow its profits into the future in a way to justify the current valuations? Let's analyze key quality, growth, and value metrics to find out. Let's start off by looking at the key quality metric, ROIC, shown here in blue. And we can see it's compared to the weighted average cost of capital, the WACC, in orange. As we've seen before, a high, steady, and increasing ROIC well above the cost of capital, the WACC, is our key sign of long-term value creation. So here we can see the ROIC has definitely been trending in the positive direction for the last 4 years. It's even gone positive, though it is still below the WACC. And so something to watch out for in general, as companies head towards profitability right after their IPO, it still may be early to decide, is this a high quality long-term value creator? Because the trend just hasn't been established. However, by looking at their most recent quarter data, we could see a 10% ROIC compared to a 15% cost of capital. And so by that metric, we would say it's not creating long-term value. Nonetheless, it's not so surprising, and it's part of the reason why young public companies are more difficult to evaluate for that long-term stability. So that's something to keep an eye on. What about growth? So here's a plot of revenue in green, the top line of the income statement, and invested capital here in purple. Now we can see the latest quarter was a revenue of $1 billion, in fact, $1.004 billion. And that's what the nonsense news is focusing on. But here we can look at the trend over the last 4 years. Now notice this is on a log scale. So a straight line corresponds to exponential growth, and a higher slope of that line means a faster rate of exponential growth. And so what do we see here? Well, revenue has been growing, and in fact it's grown at a 28% CAGR, compound annual growth rate, for the past 4 years. Good sign. Invested capital, that equity plus debt that the company can put to work, has also grown significantly, 29% over the past 4 years, though the company has continued raising equity by diluting shareholders. So we do see that there is this nice exponential growth behavior, even though we only have a few years of data to work off of. All right, that was quality and growth. What about the valuation? The biggest red flag when it comes to Palantir is the valuation. The stock is up over 550% in the past year. And while there's nothing wrong with a high price per se, we need to ask how this price compares to the value, what we get in exchange for buying a share. So here's a plot of the hype factor in green, which is a ratio for the invested capital acquiring cost of the business to the market price we pay to acquire that invested capital. Think of it similar to a price to book ratio. And we're also plotting the long-term equilibrium hype in pink, which is the median. So half of the time it's above, half of the time it's below. And so that gives us a sense of the historical valuation. Now we should keep in mind, again, this is only 4 years of data, so that long-term equilibrium shouldn't be overinterpreted. Nonetheless, we can look at the hype factor and we see it is in the stratosphere. We see the hype factor from last quarter was 49x. And since the post-earnings jump, it's gone up to 63x. So that means $1 of invested capital on the books is valued by the market at $63. So is Palantir's capital really worth that much more when compared to the competition? History shows us that hype moves in cycles. And when the hype factor is in the stratosphere at massive multiples like this, the company has to execute perfectly, has to fend off competition in the marketplace. And over time, the forces of market gravity will pull this hype factor back down to reality. It is quite the challenge to find a company that has reached this level of hype factor and has come back down while still managing to beat the market with returns. We can look at this another way by considering the PE ratio, the price to earnings ratio of Palantir. So Palantir is currently valued at a 780x PE ratio. To get that in line with the 27x PE ratio of the S&P 500 index, the company has to increase its earnings by a 29x factor, while the price stays flat. So these valuation numbers clearly show that investors are hyping up the stock and betting on massive growth. And so the question we have to ask ourselves is, can Palantir grow to meet those expectations, continue operating at peak efficiency, and satisfy the paper hands who are still buying in at a PE ratio in the stratosphere, 780x PE ratio? Can the company meet those expectations? And can it do it on a timescale that would satisfy investors? Remember, no one can predict the future, especially in the near term. But by looking at these key long-term metrics, we can avoid getting caught up in the nonsense news and base our long-term investing decisions on solid fundamentals. So invest for the long term and keep compounding knowledge.